Hello and welcome to Wall Street Training's module on Finance 101. My name is Hamilton Lin and I have a background in investment banking and mergers and acquisitions, having worked at Goldman Sachs in investment banking, as well as Bank of America Securities in the mergers and acquisitions group, as well as two other boutique investment banks, all focused on mergers and acquisitions. I am a CFA charter holder as well and the president and founder of Wall Street Training. In the next little segment, we will go through an explanation of the basic financial concepts that one must absolutely master, what we call the Finance 101, Introduction to Finance Topics, that one must absolutely know in order to be able to understand the concepts in the basic financial modeling, valuation, how to analyze and rip apart companies. With that in mind, let's turn to our slides. Mental exercise on WACC. You are provided with the following information about Disney's WACC. You have told that Disney's WACC overall company, this is the entire overall company, is 10%. Their retail store WACC is 8%. Their theme parks is 12%. So the question now becomes, if I've determined that the IRR, the new project for IRR, remember what was IRR? This is the rate of return to get my MPV, my investment, to zero. And the idea is we will now take a look at this internal return versus our cost of the capital and to figure out what we should actually do. So this is a bit of a tricky question. It's a tricky question because now I'm asking you, if the theme park is 11%, do I reject or accept the project? The choices are pretty clear. First of all, our observation is that the IRR of this theme park, 11%, is greater than Disney's WACC of 10%. Because if that's the case, this means I should invest. Why? Because I will beat the overall company's WACC, so overall company, I will be profitable if I accept this particular project. In other words, my return of this theme park is greater than the cost of the capital issued or required to fund this theme park, and therefore, it's a profitable project, I should undertake it. However, if the IRR is less than the theme park's WACC. In other words, that IRR of this new theme park is 11%, but my actual theme park WACC on a project-specific basis is 12%. Then one can say, don't invest because on this project-specific WACC, I have not made my required return. And if I've not made my required return, this 11%, less than 12%, I should not invest in this investment. So those are the observations that we will make. Now the question is, which one of these is correct? Well, let's look at the retail store first before we come back to this overall answer. For the retail store, same situation. I've determined that the IRR, the return is 9%. The question now becomes, do I reject or do I accept the project? If I reject or if I accept the project, what's the same decision? The same decision observations say as follows. My retail store is a 9% return. This is less than the 10% of the entire company. And one can say, you know what? Don't invest. Why not? Because my 9% did not beat the 10%. On the entire overall company, I will lose money. Therefore, don't invest in the project. However, same thing as the theme parks on top. The retail store is a 8% WACC, and the return is 9%. So the question now says, well, you should invest because it beat the project-specific WACC of 8%. Therefore, on a project-specific basis, when I am able to issue debt specifically for this project, as well as for my equity mix, my weighted average cost of capital for this project, this is going to be profitable. I should invest. Now, here's the conclusion. Which is the correct answer? You must match the risk with the cash flows. Remember, this 10% is observable because this is probably an average of all other projects within Disney. And therefore, this is just an observation. This is not the actual number to use. You should use project-specific cash flows. In other words, if I end up investing in only 10% IRR projects only, this is the overall WACC for the entire company, I will lose opportunities that would have been profitable. In other words, folks, think about this. If all I'm doing is investing at 10% projects, if I had a 9% project that would have been profitable because the cost of attaining the capital for that 9% project was lower, then I would have lost out on that opportunity. And I would effectively only invest in 10% projects. And if the company's overall WACC is 10%, and in this case, the retail store WACC is 8%, and if the theme park is 12%, if I only invested in those greater than 10% IRRs, I would never be able to have a single retail store. And the ironic situation, as we know, is Disney has sold a great amount of their retail stores, just about all of them. So looking back to our slide, here's our decision. We should not invest in this particular theme park. Why not? Because our 11% theme park is less than the overall theme park for the WACC. The WACC of the theme park, and therefore it did not beat my project-specific WACC, do not invest. I, however, should invest in the project of the retail store because I have a 9% IRR versus an 8% WACC. And when you look at it from that perspective there, I should invest because I did beat the project-specific WACC. And again, think about this. If I did not make this decision on project-specific, matching cash flows with the discount rate and the risk, I would have decided to reject the retail store. Why? Because it only returned 9% and my overall company was 10%. However, I should have invested in that store. Likewise for the theme park. The theme park returned 11%. If I only evaluate that against the company's WACC of 10%, I would not have this project. I would invest in this project. However, the cost of obtaining the funds for that theme park is 12%, greater than the 11% return, and therefore I will end up losing money on that particular theme park. So therefore, the conclusion is that you must match the cash flows with the appropriate level of risk, the correct discount rate. Folks, that just about summarizes our module on Finance 101 Introduction to Finance, which is a very quick crash course on all the basic valuation concepts that you need for finance. Think about this. The present value of all future cash flows, that equals the value of any asset, whether it's a company, whether it's a stock, whether it's a bond, whether it's real estate. Of absolute critical importance is the fact of this discounting factor. You must make sure you absolutely understand and can calculate backwards and forwards, future value, present value, as well as net present value of an uneven series of cash flows, internal rate of return, net present value, as well as the WACC and whatnot. Understanding the concept of how all of that integrates into capital markets theory, the capital asset pricing model, betas, total risk, diversifiable risk, non-diversifiable risk. Those are all important concepts that you must master in order to be able to successfully navigate all of the different things that you will encounter when you're building financial models and valuation. Thank you very much.